Good morning, everyone. This is Sven Borho. I am a managing partner of OrbiMed Advisors, and I'm a board member and a portfolio manager of the Worldwide Healthcare Trust. On behalf of OrbiMed and my team, I want to welcome all of our shareholders, stakeholders, and old friends to our 2020 annual meeting for the Worldwide Healthcare Trust. It has been a very special, but at the same time challenging year. This is for the first time in 25 years that we cannot make our annual investment presentation in person in London. But I hope I can make this virtual presentation as informative as a live presentation. Today, I will cover a whole range of issues. First, I will give a brief OrbiMed update. Then I will review our performance for 2020. I will cover the most important investment themes for the next 12 months. And then finally, I will discuss our playbook and tactical positioning for the coming months. I already mentioned that 2020 is a special year for the trust. It is actually our 25th anniversary. The Worldwide Healthcare Trust was started 25 years ago in April 1995. It has been a wonderful ride for all the stakeholders in this fund. We are obviously very proud of our investment record over this period. Healthcare in general has been a terrific sector to be invested in. Our sector has been beating the overall market for the past 25 years by a very significant margin. But we were able to significantly outperform the healthcare sector index by a large margin. And now we are the #1 performing UK investment trust for the past 25 years. This includes all funds, not just the healthcare funds. Now, the future for healthcare innovation is still very bright. And I'm confident that healthcare in general will continue to outperform for the next 25 years. And I'm confident that the recipe for success for the outperformance of the past 25 years is still very much in place here at OrbiMed. You know, just like the Worldwide Healthcare Trust, OrbiMed has been started well over 20 years ago with one single mission: find the very best healthcare investment opportunities any place in the world. Now, what's unique about our firm is that we have the ability and expertise to invest from a small university startup to the large mega cap companies like AGM, Pfizer, and Merck. We invest in any part of the capital structure of healthcare companies, not just equities, as well as converts, royalties, and debt. And most importantly, we are investing in every single healthcare subsector. Let me give some examples here. For example, we can find an exciting gene therapy company in the small cap biotech sector, or a liquid biopsy company in the tools and diagnostic space. Or we find a continuous glucose monitoring company in the medtech space, a hospital or generics company in India, or even a fertility clinic in China. So the one thing that sets us apart from anyone else in the healthcare space is our truly worldwide approach. Our headquarters are in New York, but we have approximately 11 locations worldwide, including San Francisco, Mumbai, Shanghai, and Hong Kong. We have always opened new offices to get close to markets where we see key innovation or incredible growth rates, like the emerging markets in China and India. Now, the Worldwide Healthcare Trust portfolio management team is run out of New York headquarters, and most of the public equity team members are based out of there. You know, the next slide covers the growth of OrbiMed Advisors. OrbiMed has grown very significantly over time. We have now in excess of $13 billion asset under management, possibly by year-end close to $15 billion. You see here in the chart our royalty and credit funds, our private equity funds. These are our venture capital funds where we can invest in these university startups. See the other public equity funds. But then most importantly, you see there the Worldwide Healthcare Trust at $2.5 billion. It's the largest fund inside OrbiMed Advisor and has now become our flagship fund. You see there as well the Biotechnology Growth Trust, which is the sister trust investing just in biotechnology name. Now, our large footprint is a huge competitive advantage, but our most important competitive advantage is actually the size of our investment team. And this is the second column here on this slide. You know, I always like to compare it to an arms race. I always say, this is the arms race. OrbiMed Advisors always wins. We have a total of 100 investment professionals dedicated to picking stocks in just one single sector, healthcare. We have 30 PhDs and MDs, 15 ex-CEOs and founders of healthcare companies. So an extremely strong team. This is our key asset. You know, I think you're really familiar now by now with your portfolio managers. Trevor and I are leading this fund as co-portfolio managers, but we have all of the support of all the team, all the senior equity analysts on the public equity team. They contribute their very, very best ideas for this trust. Now, Trevor and I, we share the responsibilities of communicating to our shareholders. So you will see from time to time, either one of us, you know, talking via a video conference or on the phone, or hopefully sometime soon in person meetings again. So how did we do in our last financial year? Well, I think we had a solid year. You know, it was a very, very challenging financial markets backdrop. But we had absolute performance, or positive absolute performance of 6.5%. We had positive performance both in British pounds and US dollar. And as I said, this is not bad given the challenging stock market environment. You know, our share price did slightly better than the NAV. It was up 8%. We had positive alpha generation of 70 basis points over our benchmark, the MSCI Worldwide Healthcare Index. This was not easy actually beating our benchmark last year because we had a very slow start to our fiscal year. The first half of the year was quite pedestrian. Now, overall on the year, I think healthcare and the trust had a very strong relative performance vis-a-vis the broader stock market indexes like the S&P 500 or the FTSE All-Share Index. Emerging markets was the best performing subsector in fiscal 2020, generated 690 bips of contribution. Second best sector was emerging biotech with a positive 161 basis points of contribution. Other positive subsectors were large cap pharma, medtech, and healthcare services. Now, the largest negative performance came from spec pharma and generics names. They cost us 170 basis points during the fiscal year. Other negative subsectors were Japan, large cap biotech, and life science tools. Now, coming to the premium, well, the fund has typically been trading at the 1 to 3% premium to an NAV over the past few years. There were only two periods during the last year where we were trading at a discount. One period was in March when the markets got extremely volatile. The other period was in October, November, when we had incredible performance and the NAV was rising really fast. Those were the only two periods where we traded at slight discounts to NAV. Our target is to be at parity or at the slight premium. So right around where we currently are. Our dividends per share, I think policy continues to be there. We want to offer a nice little dividend to our shareholders. Now, I mentioned already, 2020 fiscal year started out on the difficult side. You know, our performance in the first 6 months of the fiscal year was very pedestrian. It wasn't just the absolute drop of minus 2.7%, but more importantly, it was the relative performance of minus 8.7% vis-a-vis our benchmark, which was up 6%, or the broader benchmarks, the broader markets, which were up actually during the first 6 months of the years. The key driver of our underperformance in the first half of our fiscal year was our overweight position in biotechnology names. They cost us 513 basis points. The only positive highlight in the first 6 months were emerging markets position of positive 261 basis points. Now, it's important to remember the first half of the year saw the emergence of very liberal presidential candidates as frontrunners here in the United States. So it was Elizabeth Warren, and then in the fall, Bernie Sanders. These were candidates which were promoting Medicare for all, or full government control of the healthcare sector. And this is what was the key reason for the challenging first 6 months of the year. But then the second half, oh wow, second half was in a complete reversal. We had an incredible strong September to December period, one of our strongest quarter possibly in the history of the fund. We did really well, I think, for the full fiscal year, fiscal second half of the year. We were a plus 9.4%. The MSCI was slightly down actually for that period, and broader stock market indexes were significantly down. You know, this performance was driven by emerging biotech, positive 505 basis points, and emerging markets, positive 421 basis points. You see there in the as well the COVID-19 dip in March, and then a nice little recovery here into the end of the March. And then I will talk about this later on in this presentation, but we have a terrific start to the new fiscal year. So the period March 31st to June 30, 2020 is almost as spectacular as the third quarter of last year. So really, really strong start to the year. So looking at our biggest percentage movers for the year, you know, the most important thing here is to have a good year. You want to have your winners to be much bigger than your losers. And that was the case last year. So we had huge winners in some emerging markets names. Cancino up 283%, AlphaMap 137%, Hanso, terrific performer in emerging markets. Dexcom's a very exciting medtech name, fastest growing name in the medtech space, had a terrific year, up 136%. eHealth, it's a services name, fastest growing services company in the United States. Great performance during our financial year, up 136%. Arcule, a biotech cancer company, was taken out by Merck in December of last year. Decipher, another huge winner, had successful phase 3 data. That was the driver behind the stock. We have always some losers as well, but most importantly, when we do have losers, we will aggressively cut our losers. And of those 10 names listed there below, 8 out of those 10 names we have actually completely sold out of. We right now only own 2 of the losing names from last year, Myriad GTX, a gene therapy company, which we still very much like, and the Phoenix oncology companies. But we were quite good at cutting then our losers as well during the fiscal year. Here you see, I think, the chart in top 10 major movers in terms of contribution. Here again, Cancino Biologics, 320 basis points, was the outstanding performer of the year. And the eHealth, Arkwell, Deciphers, very, very diversified across a number of sectors. Diagnostics, tools are there, biotech names, emerging market names, medtech names, Chugai, a Japanese pharmaceutical company. And on the loser side, you see actually our two biggest losers, and they deserve a little bit of an explanation. This is Alexion and Takeda. Now, the reason why they underperformed is they had an incredible start into 2019. So Q1, calendar year 2019, Alexion and Takeda were stellar performers. We held them in the fund back then. They pulled back actually in the during our fiscal years, and that's why they are our biggest loser. But we kept on holding on to those positions, and they've started again to contributing very, very nicely in the new fiscal year. And then again, most of the other losers, we actually traded out of those names. I already briefly mentioned it. Terrific start to our new financial year. Incredible snapback from the severe market pullback based on COVID-19 during the month of March. And the fund is up here in the first 3 months of the year till June 30, up 25.6%. It tremendously outperforms our benchmark by 10.6 points. So we have a lot of alpha here starting to the year. Every single subsector has been green, significantly positive. And again, emerging biotech names were leading, positive 846 basis points. Emerging markets, the other standout subsector, positive 825 basis points. What's actually really interesting about the start of this financial year is that our number one performing stock in the first 3 months is a spec pharmaceutical name. This is Horizon Pharmaceuticals. It's a relatively new name in the trust. This has been a subsector which has been challenging the past few years. It's just great to see a spec pharma name being the number one positive contributor here to start out our fiscal year 2021. Other big winners here early on in the year, Burning Rock, crossover private investment, which went public on the NASDAQ. It's a Chinese liquid biopsy name, positive 136 basis points. Natera, a United States-based liquid biopsies diagnostics company, positive 133 basis points. Mirati, an oncology company in the biotech space, positive 123 basis points. And then the two losers from last year, Takeda and Alexion, really strongly positive. Takeda up 113 basis points, Alexion up 123 basis points. Now, you have seen this slide before. This slide shows all of our annualized returns for all time periods. Here you see 3, 5, 10 years, and since inception. We are obviously encouraged to have consistently beaten our benchmark over every single period. These are great returns, I think, for every single one of those periods. But the one period I want to highlight today is our 10-year annualized returns. And you see it there, it's a positive 19.3%, almost 20% annualized returns for 10 years, which is really remarkable. But it's important to remember that of those 10 years, not every single year was a great year. 2016 was challenging. 2018 was another challenging year. But when you look actually over the longer term, those challenging years, they just disappear, and you get really attractive long-term growth rates. And this is really the target rate of return for the Worldwide Healthcare Trust. We want to be somewhere between 15 and 20% annualized rates of returns over a longer time period. This is how the portfolio is structured. We have a portfolio and a strategy which should deliver 15 to 20% performance over the long term, but it will not come every single year. So expect some volatility, but really attractive long-term growth rates here inside the fund. Now, typically, this is the key part of my presentation, investment themes. But today, I will not cover many of the usual themes that I usually like to talk about, like M&A trends, FDA approval decisions, valuations, and so forth. Instead, today, I really want to focus on the most important investment themes for the next 12 months, the areas that I really believe which will be the key for our investment performance for the next fiscal year. You know, quite clearly, the number one investment theme for both the market in general and for our healthcare sector is the further development of the COVID-19 crisis. You know, one thing is crystal clear, COVID-19 is here to stay. You know, all of the efforts by governments worldwide had only modest success with containing this crisis. Some governments did a little bit better, like several of the European countries, like Germany, Korea, Japan, but a lot of other countries did extremely poorly. United States did a terrible job. Governments will not solve the crisis just by lockdowns, social distancing, wearing face masks, all of that. You know, conquering COVID-19 will require one thing: the R&D success of the biopharmaceutical industry. And the response of the biopharmaceutical industry to this crisis has been really remarkable. Look at what the diagnostics companies have done in the last few months. They have been extremely successful in rolling out COVID-19 tests. Here in the United States, it's very easy to get tested. If you want an antibody test, you can go off the street, right into a LabCorp facility, get tested that day, and next morning you have the results. If you want to get active COVID infection test, the nasal swab test, you need to book it maybe a day ahead of time, get the test, and you get the results the following day. So diagnostics tools are there. The industry has been very successful in rolling it out, and it will become more and more available in the United States, and I think in Europe as well. So on the diagnostic side, the industry is really successfully addressing it. Now, on the therapy side, there has been a lot of great progress as well. We have seen some great data by Gilead for remdesivir, the antiviral drug. It got already US approval, and it is available on a limited basis in everywhere in the world, mostly in the United States. We got some really incredible data as well, just in the last few weeks, on dexamethasone, a corticosteroid, which is widely available, very cheap, generic, and it had some stunning data in actually treating late-stage COVID-19 patients. So we have seen the first approvals and successful trials for COVID-19 therapeutics. And the next few weeks here, over the summer months, we will hear a lot more news. You know, the one which I'm most excited about is a COVID-19 antibody by Regeneron, but we will hear tons of news on new therapeutic agents, and we will have, by the fall, quite a few number of therapeutics available for treating patients suffering with COVID-19. So that's another possible check mark where the industry, the healthcare industry, is really delivering. You know, but this crisis will not be over until the biopharmaceutical industry will deliver an effective vaccine. And we are really hopeful that we will succeed with bringing a vaccine to the market, starting maybe in Q4 for high-risk populations like healthcare professionals or the military, and then possibly in Q1 that we see a broad rollout. Now, there is a race actually between China Chinese vaccine efforts, and United States and some UK-based vaccine efforts. One of our portfolio companies, CanSino, actually has been leading that race. They have the most advanced vaccine trial data. And actually just a few days ago, they got Chinese approval for the military to use the CanSino COVID-19 vaccine in the military. I think there are a number of attractive candidates. China is probably leading the way, but probably the most effective vaccines will come possibly from AstraZeneca with Oxford, Sanofi, Glaxo. I think Merck has a very strong candidate. Pfizer has a very strong candidate, and then Moderna as well. So there is a lot happening. We will see some exciting news there as well happening. And I am confident that the biopharmaceutical industry will solve the COVID-19 crisis. And then slowly, first quarter, second quarter of next year's, COVID-19 will maybe fade into history when broad vaccinations will be available. And this has been a terrific opportunity as well for our industry, the healthcare space, and especially big pharma and biotechnology companies to change their public perception. Everybody will understand, I think, by this time next year that the biopharmaceutical industry is the savior of this crisis and is the true hero of this crisis. Next big theme. Well, we have our presidential election coming up. It's happening on November 3. We had 4 scenarios. 3 scenarios are still on the table. And the one scenario that is off the table here, Bernie Sanders, a very liberal Democrat, and leading to a Democratic sweep of the House and the Senate, that scenario is off the table. Now, the fears of this scenario number 4, was the reason why we actually underperformed in the first half of last fiscal year. It's great that that scenario is off the table. And actually, scenarios 1, 2, 3, they're all good for the healthcare sector. I think they're all manageable. The best case scenario would be scenario number 1, where Joe Biden will win the presidential election, but we will have a split Congress where Republicans hang on to control of the Senate. I think this scenario is the Goldilocks scenario, best case scenario. Scenario 2 and 3, well, anyone's guess, if Donald Trump still has a chance to get reelected, or if the Democrats will sweep actually the Senate. But I think either one of those scenarios is manageable for the healthcare sector. So take-home message here is worst case scenario is really off the table, and we can perform with any one of the scenarios 1, 2, 3. Without COVID-19 and without the presidential election, this is the slide where I would spend most of my time talking about. Innovation is firing on all cylinders inside the healthcare sector. We have tremendous hotbeds of innovation in gene therapy and biotechnology, in the oncology space. There are bispecific antibodies, great new immune therapies, great targeted therapies coming. But we have innovation actually across all healthcare subsectors, like liquid biopsy, a theme which we're really heavily playing in the trust, in the diagnostic space, robotic surgery, continuous glucose monitoring, TAVR heart valves in the medtech space. An incredible launch of like a Vertex drug, which is going to be a mega blockbuster drug in protein modulation for cystic fibrosis. There has been innovation in every single space. And I talked even about the innovation of our industry in the COVID-19 space. This page, this is the reason why you want to be invested in a healthcare fund like the Worldwide Healthcare Trust. And this page, this is the reason why I'm so confident that healthcare will continue to outperform the broader market into the foreseeable future. Now, this slide is a new theme for the trust. You know, we have started to really do over the past 2 years our first private investments, some crossover investments. We've done some cornerstone IPO investments in Asian companies. Now, this is a new strategy, but it generated $250 million in gains over the past 2 years, or 13 points of performance. So this has been an incredible, successful strategies. Now, you know, privates and cornerstone IPOs will not always work, but right now, I think there will be quite a bit of performance coming out of this sector. Now, the biggest driver there has been our investment in CanSino Biologics. That's a Chinese vaccine company with a COVID-19 vaccine. We originally invested as a cornerstone investor, as a semi-private investor, at the IPO price of 22 Hong Kong dollars. The stock went actually up more than 10 times. You know, it's trading right now 120 Hong Kong dollars. And obviously, we have been, you know, with a 10x winner, we have been trimming this position steadily throughout the rise. But there are many other winners here on this page, like, for example, Peloton, which was a US private biotechnology company. They were about to go public and then Merck acquired them. Our gain there was 130%. Burning Rock is a very good recent example. It's a Chinese liquid biopsy company. We invested in a private venture capital crossover round. They went public on the NASDAQ and we are already up 101%. AlphaMap, a Chinese biotechnology company, very similar. We're up 120% after first investing on the private stage, company going public. And then Shanghai Kindly up 109%, Hangzhou up 144%, Akizo up 127%. So you see on this page there have been a lot of great winning stories there. And then I want to mention as well emerging markets. You know, this has been a theme what we have highlighted for a number of years. We are convinced that Asia and China in particular is in the verge of becoming a major worldwide powerhouse in the biopharma sector. So if you invest today in Chinese biotech, this is the equivalent of investing in emerging Chinese technology companies 10 to 15 years back. So today you have the opportunities to invest in a Tencent, Alibaba, or Baidu of 10 to 15 years back. And, you know, I mentioned it already, you know, the current COVID-19 crisis has shown how far China biotech has come. China is actually leading the worldwide race for the development of a vaccine. They are no longer copycats of Western technology in biotechnology. They're actually leading now in many areas. Now, how do we invest in emerging markets opportunities? Really straightforward, two basic strategies. Strategy number one, invest in the blue chip leaders across all of the healthcare subsectors, like a Jiangsu Hengrui, an AI hospital, or a Ginseng fertility clinic provider. Then the second part of the strategy is, and I mentioned it already on the previous slide, is to focus on IPOs crossover opportunities here in the emerging markets, like CanSino, AlphaMap, and Burning Rock. And emerging markets has been our top performing subsector in the last fiscal years, and we are confident that we will continue to perform there in the current year. Now, this is a quite important slide, and this shows the worldwide healthcare trust leverage or gearing over time. And you saw in the history of the fund, we were usually invested geared between 110% and 120%. Really, the first time in March of 2019, we lowered actually our exposure. This was really on the back of tremendous performance of the trust in January and February. And we took some money off the table, sold some of the winners, took it down to 105% invested. This scaled up a lot due to performance and some new crossover investments, scaled up to back to 114% in December of 2019. And now we have again reduced actually our exposure. We have been taking profits in a number of names across all subsectors, emerging markets, Japan, biotechnology name. And here actually right now, we are for the first time actually invested only at the 95.9% level. And this shows you really a snapshot of the portfolio from 1 year ago to today. So I would highlight, the bottom line, the total number. There you see we went from 108% invested to only 95%. Emerging markets has increased from 15.2 to 18.2. That's mostly due to performance. We have been selling a lot of the names there, but still it had kept on going up. Same thing holds true for emerging biotech. We have been selling some of these small mid-cap biotechnology names on strength, but still performance has increased our exposure there from 20 to 22.8. But then you see the big reductions. You see medtech devices from 21.3 to 9.3, so fairly dramatic reduction in the device names. Japan, we cut in well over half. We sold Chugai, we sold, trimmed back some Takeda, and that with a lot of this selling has led to our decrease in exposures. One thing what I maybe want to stress is now is not the time to buy names associated with COVID-19. Now it's the time actually to sell the strength in those names. A lot of the good news there is already reflected in the share prices. And this is the reason why we have completely sold out of Gilead or Regeneron with great run here earlier this year. Chugai in Japan was perceived as a COVID-19 name. We completely sold that out of the fund. And then I mentioned CanSino, which had been a 10x performer for us. We have been steadily selling down that name because the share price improved so much. With that, I will talk a little bit about our playbook for 2020. What I'm hopeful, and the reason why I'm 95% invested is that we maybe get a buying opportunity over the summer months or the fall months to fully lever the fund back up. We have a lot of dry powder, but we will continue to use the gearing quite tactically. But I'm itching to put money back to work, and it would be possibly be in the medtech name or large cap pharma name as well. But hopefully we will get a better entry point here in the near term, and we will put more money back to work. We will continue to trim any exposure related to COVID-19. I think the news has been heavily discounted in those names, and many of those names are quite overvalued. We will continue to be very active in emerging market, crossover investments. I think this is a strategy that I highlighted that will continue to work. We will continue to focus on the most innovative and fastest growing companies, especially in the biotech space. Now, we are really happy how the year has started, but we are quite optimistic that we can build on a successful start here to the year in the first 3 months. So with that, I thank you very much for listening to our annual investment review. I hope I will be able to see you all in person in London in the not so distant future. With that, thank you very much and goodbye.